Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Alconin, along with Brianna Valesky, and we have Andrew Zatlin on the line. He is the editor of Moneyball Economics. Getting back to the swing of things here on Tuesday, following Labor Day.
Wow, welcome back, everyone. Top of the morning. Hey, Joel, how are you?
We're doing good. We're doing real good. So, Moneyball Economics. You're the editor of Moneyball. Now, I know Moneyball from the movie, and I think also Theo Epstein runs that. A lot of things have happened in sports, but you run it in the economy. Tell us about your slant on the economics from the perspective of Moneyball Economics.
Well, just to level set a little bit, obviously, I'm more of the Brad Pitt and the Jonah Hill character, and at least I like to think so. Ultimately, what Moneyball Economics is all about is just like the movie. There comes a point in time where the game changes, and we have to take a step back and with a fresh pair of eyes, come at it with a fresh set of data points and say, look, these data points are more reflecting what's going on in the economy today versus stuff that was invented 100 years ago. And those data points may not be as relevant. And what we do at Moneyball Economics is take a step back and with that outsider's perspective, that Jonah Hill perspective kind of a thing, say, look, we are not beholden to data points that were invented 80 years ago, or we're not beholden to a view of the economy that was locked in before the internet existed. We're going to come at the world, we're going to leverage our understanding of the way the global commerce and industry is really interacting. And we're going to look for the data points that then are going to give us that early insight. And that's what we do. So it's leveraging big data. It's leveraging an awareness of, for example, I've been in Silicon Valley for decades working here, plugging away. And I've had firsthand experience in what I call the 21st century economy. What we buy, where we buy, how we buy, it's all different. But at the same time, you need to understand what those differences mean and how they play out. And that's what we do.
Yeah, now we're getting to the good part here. So what you're using as indicators for the economy are the vices, which we all have here. So talk about how you came about that discovery. What vices do you focus on? Not
Absolutely.
personally.
Hey, top of the morning, everyone. Let's talk booze, broads, blackjack, and bond hits. Okay.
All right. Well, could you tweet that out, please? All right. Go ahead. Go ahead. Let's go right into this.
I'm just waiting for the IRS to poke a little closer in my expense reports, right?
No.
As long as it stays with the IRS and doesn't go to the family, I'm okay with that.
Are you hiring, by the way? Are you hiring?
I need some feet on the street help. Yes, exactly. In all seriousness, so this is interesting. I don't know if everyone is aware of this, but we've got a lot of benchmarks that come out every month, and those are supposed to be the be-all and the end-alls. One of them is consumer sentiment. Well, it turns out that the way they get to this magic number, which can move the markets, the way they get to it is they'll call 400 people, Joel. 400 people. That's fewer. That's as many people that just quickly got a cup of coffee in that 5 seconds you and I were talking, right? That's meaningless. So here you are, the market's being guided by what is essentially statistically useless. What I do is I track tens of millions of transactions, and I think we can pretty much agree that you're going to get better information out of millions of events than you will from 400 phone calls. And why do I track vices, you say? Well, if you had to pick something, would you rather track cottage cheese sales in Maine, or would you like to track escort activity across the U.S.? That was rhetorical. You don't have to answer that one. But take a step back. Last year, the Bank of England recognized that prostitution and drugs were a big expenditure, and they started incorporating it into their GDP estimates for England. In fact, last year, Great Britain rather, generated, off the top of my head, I think it was like 2.1% GDP, of which 0.7% or 1/3 of that GDP escorts and drugs. We have a similar economy, and we have a similar gray market of a lot of underground or illicit activity. And our economy is much larger. If we were to sort of translate that, I think estimates are that of our $12-13 trillion economy, unmeasured is about $1 trillion. So you have a large economic amount of activity being spent on what we call vices. Some of it's legal. Gambling gets measured, alcohol consumption gets measured. But for the most part, a lot of this activity isn't being measured, but it's really critical. Here's why. So you asked, why would I do it? In all seriousness, here's why. When we talk about the consumer, we want to know, is the consumer stepping on the gas or stepping on the brake? And we want to know that pretty quickly. And there's a lot of data points that sort of triangulate around that. One of them, for example, is, as I said, consumer sentiment. Another one's retail. Well, retail is really a tiny slice of spending. It's if I went into a store and bought something. It doesn't take into account all the spending that goes on going to movies, going on trips, going to Disneyland, gambling. In other words, a huge chunk of consumer discretionary spending is being ignored when we talk about retail. And so you can get really bad data as people shift from buying things to buying experiences. And when we're talking about consumers, we're talking about discretionary spending. We're talking about that feeling of I've got cash burning a hole in my pocket. What am I going to do with it? Well, it turns out that gambling, prostitution, alcohol, these are all forms of discretionary spending that actually have they're sort of the tip of the iceberg of behavior, because you really don't need to go gambling. In fact, it takes a little bit of effort to go hit the casinos. So all of a sudden what you've got is a really early indicator for what's about to happen with consumer spending. And so what we show on Moneyball Economics is I've got over 20 years worth of monthly data tracking these vices, and they correlate so strongly to retail spending, for example, but they do it with months in advance, because the first place people go to cut back, or the first place they go to splurge, is going to be on vices. Now, everyone has their own version of vices. I mean, Brianna does. I mean, Joel, you have no vices. I know this. But other people, well, we have our own vices, and sometimes they overlay with these vices. And the cool part is, again, we're talking, Vegas. Every month, 3 to 4 million people go to Vegas, and that's just one of the casinos in the U.S. So you're talking millions and millions of events going on every month when it comes to gambling. Same thing with escorts. Same things with drugs. Millions and millions and millions of things are going on. So you can track this data, and thereby you can understand if people really do have money in their pockets and they're willing to spend not just today, but tomorrow. Because one last point here, a lot of this stuff's illegal. And so therefore, people have to use cash. You can't throw your credit card down. So again, do I have the money today, and do I feel comfortable about spending it? Do I feel comfortable because I have the money tomorrow? Hence vices, the vice index.
How do you track these? I mean, if it's if it's a cash market, you look at prostitution, and you look at drug trafficking. How do you measure this stuff?
Well, believe it or not, a lot of data is out there. You just have to know where to go, how to scrape websites, how to obtain the data, how to interpret the data. So again, the starting point is, if we can get to the data, that's the hardest part. Once you can get to data and you can validate that it's robust, that it's been collected the same way over time, then it's just a matter of finding a way to calibrate it. And that's the big data play. So what's interesting is it's not just the data. It's we did a survey, for example, back in January. I challenged the folks at the Wall Street Journal, Dow Jones, and at Fox Business News. And I said, look, we've got all these pundits out there, all these wonderful financial thinkers like Krugman and all these other guys. And every so often they pop their heads up and give us their opinions about what's going on in the economy. Well, let's get our finger on the pulse of the economy, so to speak. Let's ask escorts, what do they think is really going on in the economy today and tomorrow? Let's ask them business questions. Are your costs going up? Are you raising prices? Where do you see things going on? Are your customers telling you that are they indicating they've got more money to spend or less money, and so on and so forth? Did this survey in January and asked the exact same questions that the Federal Reserve asks business people every month in their reports on business. And the interesting thing was, in January, the feedback was inflation. What inflation? There is no inflation. We don't expect there to be inflation. So I pulled out of these surveys, and we surveyed, unfortunately, it wasn't millions, obviously, but we surveyed quite a lot of folks, and we got different levels. Obviously, it's kind of like the hotel industry. You've got your one-star players, and you've got your five-star luxury resorts. But we wanted to get that slice, because remember, this is cutting across every socioeconomic and demographic out there. Everybody participates, regardless of race, creed, religion, whatever. And the feedback we got, though, was to turn that into, it goes back to your question, how do we take this information? How do we get it? But then how do we convert it into economic signal? Well, this was a survey. And hey, again, go back to that consumer sentiment thing, 400 people. We didn't quite get to 400 people, but we did get a good slice of feedback that said prices went up last year. Costs have pretty much held steady. There is no reason to expect inflation, but the economy's going at sort of a coasting pace. They were not hearing from their clients that there's a lot more money on the table to spend, but they weren't seeing pullback. That was January. And I think what they saw has been exactly what we've experienced. The economy has been more or less moving along at a coasting, not an accelerating or decelerating pace, and there has been no inflation.
That's very interesting perspective on things, especially since you go back to January. So how much of this, vice economy? I mean, we talk about our GDP. I think you mentioned a figure. I think you mentioned $1 trillion. So, I mean, if you include all that, then maybe our economy's not, the GDP's number is a little bit better, employment's a little better. Is that your take?
No, actually, it isn't. It's kind of like just saying there's a layer cake and the frosting's been left off, and we talk
Okay.
about the cake and the calories. Same level of frosting. And I do want to caution everyone, we're not just about vices, but it just so happens that when we want to measure what consumers are spending their money on, it starts off with the academic level of, okay, what is the traditional way of measuring? And we go from there and say, we can now, using the internet and using big data approaches, get better information and better insight. Uh, in this case, consumer spending, vices marries really well.
Okay, well, getting right down to it, Rob in the chat, he says, there any below the radar stocks that everyday investors can look at? He mentioned CHD, Church, and Dwight. So you're doing all this to analyze the economy, analyze individual stocks. So what's your take here on the economy? And let's get to some individual stocks on your radar.
Okay, well, I mentioned, for example, Vice Index is only one type of data we
Yep.
track. The other is actual hiring. Okay, so I actually track for almost every public company. Are they hiring people? Are they hiring more people than they usually do? Are they hiring fewer people? And this is the scary part. For basically every sector out there, every public company is now hiring fewer people. That, folks, is called the top. We are now at a point where the economy is strong, but it is not growing and it's not set to grow that much more. And so that would be the starting point for any discussion I would have about stock picking. I would say, hey, be very careful because, yes, we just had a 10% blow off, or call it whatever you want. But when you're at a market top, when companies have said, hey, you know what? I've got enough people and things to meet my business demands, that's when you start the next wave, the next inflection point is, and I think I might have too many people and things. And that's where we are right now. There are layoffs that have begun in the manufacturing space. As of July, in the latest payrolls report, manufacturing laid off 17,000 people. That's not a sudden event. That has been trend. Starting last year, if you look at the data, you'll see a slower growth that suddenly over the past couple of months has turned into, whether it's durable goods, they're contracting, whether it's payrolls, they're starting to contract. It always starts on the fringe, on the margins. It always starts in manufacturing because ultimately, at the end of the day, the market may have been jerked around by quantitative easing, but ultimately our economy is about selling stuff and services. And when we're selling less stuff, it pops up in trade, it pops up in all the data. And that's what's happening right now. So if we want to talk about stock investing, we've been advising our clients for about 3 months now. Cash is not a bad place to be. We called the yuan devaluation literally every week for weeks up until the yuan was devalued. We said, look, China's not exporting. In fact, they're contracting. The only solution they have is going to devalue the yuan. And we have just started that game, by the way. And so I would caution folks about being long. We're going to have in September, October, a little gyration as people come back into the market and so on and so forth. But I think long term, our frame of reference is we've peaked. Things are not only starting to slow down, they're starting to go to that next inflection point. And what you're going to see in October is you're going to see that first initial wave of companies saying, look, we missed the top line, but we've got a get well plan. That get well plan is we're going to cut back on capital spending. We're going to cut back on hiring. In fact, we're actually going to start firing. But they got to be careful. They're going to time it for earnings calls in October, November, but you've got Thanksgiving and Christmas coming up. And so a lot of the layoffs won't happen this year. You get to January, that's when they're going to happen. So I would caution folks, be very, very skeptical of anyone saying go long.
Where's the Fed in all this then? As far as if we've already peaked, we're starting to head down, and they throw in bump up interest rates here. It seems to me you got a recipe for disaster.
If they did the interest rate thing, and I've been saying they won't, they can't. It would tip us into a recession full blown if they did that. They have a perfect track record for doing that. They raised interest rates in 2007. I mean, the Fed is stupid. I'm just going to say it out there. There's smart people who behave stupid. And I think I've got cousins and uncles who do this, who are really smart people but do stupid things. The Federal Reserve, I'm going to just lay this out there. There isn't one voting member of the Federal Reserve who got their PhD after the internet was invented. Now, let me explain why the internet matters. Thanks to the internet, the inventory management, the supply chain of the world dramatically changed. You went from companies stockpiling a lot of stuff on their shelves, tying up capital, to that falling by about 40%. A lot of money's freed up. The way the world interacts is enabled by the internet. The way you cannot get inflation today is because of the internet. If I need something and I'm a company, I know I can get it within a couple of days. And I know that I now have a lot of vendors around the world to get it to me. I don't need to stockpile. The Fed, meanwhile, doesn't understand this. Every single one of the governors of the Fed doesn't really have a framework that takes into account that we have a totally different economy. And the way it's like basically saying, instead of that wristwatch that's manual winding, you now have a quartz watch. All those pieces in there are no longer needed because this watch moves without winding and the gears and so forth. So the Fed could easily be dumb and raise rates, and I'm just going to call it out as dumb, because they don't need to. Yes, the economy can absorb an interest rate hike. You can. You've got GDP 2-3%, somewhere in that range. You could absorb it. You've got inflation low. You could absorb it. But the economy doesn't need it. We're not frothy. Like I said, we're already starting to see layoffs. We're already starting to see durable goods contract on a year-over-year basis. We're already actually starting to slip. And the window of opportunity to raise rates is also closing, because remember, we're coming up to an election year. Last thing the Fed wants to do is raise rates in the interest year and squeeze people. Not that they haven't, not that they won't, but I simply am saying it would not be smart. We don't need an interest rate. The rest of the world is cutting rates. In fact, in essence, we've already experienced an interest rate hike. The dollar's stronger. Everything you would want in an interest rate has occurred. The stock market's down. The economy has begun to slow down a little bit. The dollar's strong. Why would you actually raise rates? And even if they do, here's what's really ridiculous about this. We had one of the Fed governors, I think it was Bradley, a week or two ago, say, maybe it's not going to be 25 basis points. Maybe it's less. All right, now that tells me right there what the Fed is thinking. If you're going to raise interest rates, say 10 basis points or 0.1%, what's the point? Why would you even bother if you don't need to slow down the economy? So in other words, what he's saying is it's just a symbolic move to prove that if push comes to shove, we, the Fed, can raise rates. And I'm telling you, that is dumb to just say, well, mom says I can if I want. Come on, guys. You're the Federal Reserve. You don't have to prove anything. But apparently they think they do. Oh, we don't have to raise interest rates except by a smidge. Well, then why bother? What are you trying to prove, right? So in terms of, I think the market has positioned itself for some kind of rate cut, whether it's a rate hike, September, October, whatever. And so if there isn't one, you'll see a nice little rally because everyone's expecting bad news and you'll get a little bit of good news. The problem here is the Fed's lack of clarity. I think the market's collapsed over the past few weeks. It continued because, again, the Fed is playing this game of obfuscation. They don't want to be clear about what they're doing, which is good in poker. And it's good to be a central banker, not show your moves. But there comes a point in time when you need a little better clarity, when you need to say, look, these are the things that concern us. I mean, they kind of said that. They tiptoed, oh, yeah, we're not ignorant entirely of the stock market. We're not ignorant entirely of what China's doing. But again, that's not what the market wants. And that's why the market's remaining low. They want to know with a lot of clarity what does the Fed really think is going on? And the fact that after almost 4 weeks, the Fed has yet to really say, well, this is what we think. And in fact, I think what you're seeing now is most people looking at the Fed and saying, your grasp of the economy is not as strong as we'd like it to be.
Chris,
And
we only got 1 minute left here, and
oops,
yeah, but just where should be people put their money then? I mean, if you're talking about out of the market, I mean, where should they be putting their money?
why not cash? If you had it in cash, you'd be 10% richer than you were a couple of weeks ago.
Okay.
But I think in terms of stock picking, I think that the semiconductor industry is kind of interesting because they've been beaten down. And again, in any normal environment, you would say stay away from the semiconductors because it's a manufacturing space and manufacturing is going down. Now, I'd say, yeah, but you got one thing. China wants to buy up semiconductor companies. So you've got that combined with the fact of a lot of M&A activity about to start. I like companies like Micron. I like oligopolies and monopolies. I like companies that have pricing power. The other thing is Akamai, and again, now I'm talking from my personal book. I love Akamai because Akamai is this obscure company. A lot of people don't know it, but they're the ones who control the pipes. If you want to get download anything on iTunes, you want to watch anything on TV, and you're going through the web, you're going through Akamai. They control, and they're growing, and they've got price power. If they choose, they can raise rates and be profitable as much as they want to be, and they're going into security as well. So. There are opportunities out there. A lot of stocks have been beaten down. They're not tied to whether we make. They're tied to our lifestyle and our shift to doing more and more into the cloud. Akamai is one of them.
Oh,
Cybersecurity companies like FireEye. I like FireEye too. But
okay.
again, now you're not talking professional. You're talking personal.
No, but we like both, and we really liked your slant on the economy and analysts. A lot of great statements coming out of Andrew Zatlin. He's the editor of Moneyball Economics, joining us here on Benzinga's Pre-Market Prep. Sorry we catch you a little long, Andrew, but really a different take on the markets. We really appreciate it, and we're going to get you back on again soon.
Thanks a lot, Joel. Take care, everyone, and stay safe.